If I lost everything tomorrow and had to start completely over, I wouldn't chase after the next Apple, Amazon, or Coca-Cola. I wouldn't spend my days poring over annual reports, calculating intrinsic values, or trying to figure out which stock would outperform the market. I've spent nearly a century learning how to analyze companies, studying businesses page by page, year after year. But here's the surprising truth. For most people, all of that work isn't necessary. Instead, there's a simpler, smarter way to build lasting wealth, and it revolves around three ETFs: patience and the incredible power of compound interest. You might be thinking, wait a minute, Warren, you spent your entire life picking stocks and building one of the largest companies in the world. Why would you recommend something so simple? And that's exactly why I'm saying it. What works for me, someone who has made a career of analyzing businesses, isn't necessarily what works best for everyone else. In fact, it isn't even what I've instructed my own family to do. When I'm gone, 90% of my wife's inheritance will go into a low-cost S&P 500 index fund and the remaining 10% into short-term government bonds. That's it. No Berkshire Hathaway stock, no meticulously selected portfolio of blue-chip companies. And if that approach is good enough for the people I love most in the world, it should tell you something important about simplicity and strategy. Let me share a story from my early life that shaped how I think about investing. It was 1942, and I was 11 years old. I had saved $114.75 from delivering newspapers, selling golf balls, and doing odd jobs, while my sister Doris had saved a similar amount. Together, we bought 3 shares of City Service preferred stock at $38.25 each. Almost immediately, the stock dropped to $27, and I watched in fear as nearly 30% of our money vanished. I held on because that's what I had learned even at that young age. Patience pays. Eventually, the stock climbed back to $40 and I sold. I was relieved to make a small profit, but shortly afterward, the stock soared to $200 per share. That lesson cost me about $480 in missed gains, but it taught me something far more valuable than money. Staying invested and not panicking is far more important than trying to time the market. By the age of 14, I had purchased my first real investment property, a 40-acre farm in Nebraska, for $1,200. I didn't know the first thing about farming, but I understood a simple principle. Buy good assets at fair prices and let time and patience do the work. That farm has been in my family for over 80 years, generating income year after year, independent of what the stock market does on any given day. That principle, investing in quality assets and letting them grow over time, hasn't changed. What has changed is the tools available today. Today, we have ETFs, exchange-traded funds, that make investing incredibly simple and accessible. An ETF is essentially a basket of stocks that trades on an exchange like a single company. When you buy one share, you own a tiny portion of dozens, hundreds, or even thousands of companies simultaneously. That means instant diversification. You're not betting on the success of a single company, you're betting on the economy as a whole. Historically, that has been one of the safest and most reliable bets an investor can make. The beauty of ETFs is that they are passively managed. There is no fund manager charging high fees, making trades, and often underperforming the market. Instead, the ETF simply tracks an index, like the S&P 500, automatically adjusting as companies enter or leave the index. Costs are remarkably low. Some ETFs have expense ratios as low as 0.03%, meaning for every $10,000 invested, you pay just $3 per year. Compare that to actively managed funds, which typically charge 1 to 2% annually and often underperform the index over time. Those fees alone can cost you hundreds of thousands, if not millions of dollars over a lifetime. For most people, the best course of action is simple. Invest in a low-cost index fund and forget about it. Ignore the noise, avoid obsessing over stock charts, and stay the course. Now, I know some will call this hypocritical. After all, I have spent my life picking individual stocks. But the truth is, I've spent decades studying businesses and understanding the market. That expertise is my job. It's what I'm good at. Even with all that knowledge, I can't guarantee beating the index in the long term starting from scratch today, and neither can most professional investors. Data shows that over the past 15 years, more than 90% of actively managed large-cap funds underperformed the S&P 500, despite having teams of analysts, access to company executives, and sophisticated computer models. If they can't beat the index consistently, why do you think you can? Now let me tell you about the 3 ETFs I would buy if I had to rebuild my wealth today. First is VO, Vanguard's S&P 500 ETF. This fund tracks the 500 largest companies in the U.S., giving you exposure to giants like Apple, Microsoft, Amazon, Google, and yes, even Berkshire Hathaway. The companies included are the backbone of the American economy, profitable, resilient, and innovative. VO trades around $567 per share, but most brokerages allow fractional shares, so you can invest whatever you can afford. The expense ratio is just 0.03%, which is extraordinary considering you're getting access to the 500 most influential companies in the country. VO should form the foundation of your portfolio. Over the past 50 years, the S&P 500 has returned an average of 10% annually, including dividends. Some years are volatile, with 20 to 30% swings up or down, but over decades, the average holds remarkably steady. That 10% annual return, compounded over time, can turn modest savings into millions. You don't have to predict which companies will dominate in the future. The index adapts automatically, replacing companies that fail and including those that succeed, letting the market do the work for you. The second ETF is SCHD, the Schwab U.S. Dividend Equity ETF. Unlike VO, SCHD focuses on about 100 high-quality companies that pay consistent dividends. These are mature, stable businesses like Coca-Cola, Procter & Gamble, Johnson & Johnson, and Verizon. Dividend-paying stocks provide stability and generate a reliable income stream. The current dividend yield is about 3.5 to 4%, meaning $10,000 invested would earn roughly $400 per year in dividends today. Reinvesting those dividends accelerates growth through a snowball effect, especially in tax-advantaged accounts like an IRA or 401k. SCHD has an expense ratio of only 0.06%, which is extremely cost-effective. The third ETF is QQQ, the Invesco QQQ Trust, which tracks the NASDAQ 100. This fund is heavily weighted toward technology and innovation, including companies like Apple, Microsoft, Amazon, Tesla, Nvidia, and Meta. QQQ is more volatile than VO or SCHD, swinging more dramatically in both directions, but it also offers the potential for higher growth. For younger investors, allocating 20 to 30% to QQQ provides exposure to companies driving the future of the economy. Yes, it's risky at times, but if you have the discipline to hold and buy consistently, the long-term rewards can be enormous.
Now that you know the 3 ETFs I would choose, VOO for broad market exposure, SCHD for dividends and stability, and QQQ for growth and innovation, let's talk about how to allocate them. The right mix depends on your age, risk tolerance, and financial goals. If you're in your 20s or 30s, you can afford to take more risk. A sample allocation could be 50% VOO, 20% SCHD, and 30% QQQ. This approach balances stability and growth while leaning slightly toward aggressive growth to maximize long-term returns. For someone middle-aged, you might shift to 60% VOO, 30% SCHD, and 10% QQQ, prioritizing steady income and capital preservation as you get closer to retirement. And for retirees or those approaching retirement, you might go 70% VOO, 30% SCHD, and skip QQQ entirely. At that stage, volatility from tech-heavy growth funds could threaten your ability to maintain financial security, so steady, reliable income takes precedence. Investing is only part of the equation. The real magic happens when you harness compound interest. Most people underestimate how powerful it can be. Let's take an example. Imagine you're 30 years old with $100,000 saved and commit to adding $10,000 per year to your investments. Over 35 years, investing in these ETFs at an average annual return of 9.5% could grow your portfolio to about $6.6 million by age 65. That $10,000 per year, or roughly $833 per month, may not feel trivial, but the combination of disciplined contributions and compound growth creates extraordinary results. In retirement, if you shift to a more conservative allocation earning 7%, that portfolio can generate over $460,000 per year, far more than typical living expenses, allowing you to spend, reinvest, and continue growing your wealth. The difference between investing in low-cost ETFs versus high-fee actively managed funds cannot be overstated. Consider a scenario where instead of ETFs, you used a financial advisor to invest in actively managed mutual funds, charging 1 to 2% in fees. After factoring in underperformance, your effective annual returns might drop to 7.5% instead of 9.5% and 5% in retirement instead of 7%. That small difference in annual returns drastically affects outcomes. Instead of having $6.6 million at retirement, your portfolio might only reach $4 million, meaning a $2.6 million loss purely due to higher fees and underperformance. That is the hidden cost many investors overlook, and it emphasizes why low-cost passive investing is not just a theory, it's a critical wealth-building strategy. For those willing to take an additional step, there's another strategy that can accelerate wealth accumulation: selling covered calls and cash-secured puts. Here's how it works in simple terms. If you own 100 shares of VOO, worth around $56,700 at current prices, you can sell someone the right to buy those shares at a specific price by a specific date. In exchange, they pay you a premium. If the stock rises above that price, they buy your shares and you keep the premium. If it doesn't, the option expires worthless and you keep both the premium and your shares. Over time, consistently using this strategy can add 1 to 4% to your annual returns. While options trading requires discipline and knowledge, even a 1.5% increase from options income can nearly double your retirement wealth over decades. Returning to our earlier example, that same 30-year-old saving $100,000 and contributing $10,000 annually could see their portfolio grow from $6.6 million to over $12 million by retirement purely from disciplined investing and smart use of options. But investing isn't just about math. Psychology matters just as much, if not more. Human nature works against investors in two main ways: fear and greed. During a market crash, every instinct tells you to sell, to protect what you have. During a market boom, it urges you to buy more, to chase returns and not miss out. Most people fail not because they lack intelligence or knowledge, but because they let emotions dictate their decisions. The most successful investors I've ever known, including my longtime partner Charlie Munger, share one key trait: they can sit still. They resist the urge to react impulsively to market swings, focusing instead on long-term results. As Charlie always said, the big money is not in the buying and selling, it's in the waiting. And history proves him right. The wealth we've built at Berkshire Hathaway didn't come from constant trading or chasing fads. It came from buying great businesses and holding them for decades. That principle applies perfectly to ETFs. Buy them, set up automatic contributions, and leave them alone. Don't check your balance daily. Don't panic during market drops. Don't get greedy during rapid gains. Let the process work. Market crashes are inevitable. 1962, 1973-74, Black Monday in 1987, the dot-com bubble, the 2008 financial crisis, the COVID crash in 2020. But each crash was a buying opportunity, not a reason to sell. Those who stayed invested or bought during these crises made fortunes. Those who panicked lost money and opportunities. The pattern repeats itself every time, and it will repeat itself in the future. Another essential lesson comes from my mentor, Benjamin Graham.
In the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. In other words, short-term prices are driven by fear, greed, speculation, and momentum. Long-term values are determined by fundamentals, earnings, cash flow, and the actual performance of businesses. Staying invested allows reality to catch up with temporary market fluctuations. By owning VOO, SCHD, and QQQ, you're effectively betting on the long-term growth and innovation of the best businesses in America, trusting that over decades, their value will be accurately reflected in the market. Many younger investors worry about market timing, thinking that prices are too high and a crash is imminent. Here's the truth. Time in the market beats timing the market. Nobody can predict exactly when a crash will happen. If you wait for a 10 to 20% correction, you might miss years of growth. For example, if the market rises 30% over 5 years and then drops 20%, waiting for the crash would leave you missing a 52% gain. Consistently investing over time using techniques like dollar cost averaging, investing a fixed amount regularly regardless of market price, smooths out the ups and downs and ensures your average purchase price remains below where the market will eventually go. Think of wealth building like farming. You plant seeds, water them, tend to them, and wait. Some years the harvest is poor, some years abundant, but over decades, consistent care yields enormous rewards. Dividends from SCHD are like crops. You can reinvest them, planting more seeds, expanding your farm, and over time it grows so large that you can live off the harvest without touching the principal. That's the essence of financial independence, the ability to live comfortably and securely without constantly worrying about money. Finally, the goal of investing isn't just about amassing a fortune. It's about freedom. Freedom to spend your time as you wish, to pursue meaningful work, to support causes you care about, and to live independently. You don't need to be a billionaire to achieve this. You just need enough. Enough to cover expenses, weather emergencies, and retire comfortably. By following a disciplined strategy of investing in low-cost ETFs, reinvesting dividends, and staying the course, you can achieve that enough and build lasting wealth for yourself and future generations. The method is simple, it's proven, and it works, even if it feels boring at times. Because when you look back decades from now, you'll see the results: financial security, peace of mind, and the freedom to live life on your terms.